Here we are back with another episode of our consultation series. Today I want to talk about what's happening right now in Dubai, the context around nearby conflicts, even the recent fire in Dubai Marina, and also share updated insights on a new Fitch report on Dubai's real estate. Let's break down what's actually going on here. Nearby conflicts and Dubai's stability. First, Dubai is the Switzerland of the Middle East. That means despite global conflicts and politically incorrect as it may sound, Dubai benefits economically. Why? Investors fleeing instability see Dubai as a gold standard, a financial and political safe haven, driving strong foreign direct investment. We've seen this during the Russian-Ukrainian war, the Israel-Palestine conflict, and tensions involving Iran, which is one of Dubai's earliest and most substantial investor groups. Does this affect us negatively? Not at all. Dubai is well clear of any flight paths related to regional conflicts. The UAE remains neutral and secure, unaffected by military tensions. Think of Switzerland in Europe, nothing ever happens to them, and the same applies to Dubai. Now, Dubai Marina fire, what happened and lessons learned? Yes, there was a fire in one of the oldest buildings in Dubai Marina. The building was over a decade old. I personally sold an apartment there 3 years ago, advising the client to resell at a significant profit. He recently told me I should have listened, now I do. Now, how can you safeguard yourself? If a building is showing signs of aging or wear, that's a clear signal. Don't wait for the full life cycle. In Dubai, the optimal holding period is roughly 5 years. After that, it's wise to resell to maintain capital appreciation and yield. Regarding the fire, it was mostly exterior damage, with only a few interiors affected. The developer will cover all exterior repairs, and owners are only responsible for their own belongings and the inside of the apartment. Now, private insurance can easily mitigate that risk. Importantly, no one was injured. 3,600 residents were evacuated and the developer paid for hotel accommodation during the disruption, a level of service unheard of outside of the UAE. Now, building quality and historical perspective, does this kind of incident happen frequently? Absolutely not. In the past 10 years, construction standards in Dubai have improved dramatically, thanks to advanced technology, better materials, and globalized building practices. Today's buildings are far less prone to such issues, and historically, only older towers face significant problems, like the Torch Tower, which frankly seemed to live up to its name. They should have renamed it. Market cycle and resilience. Now, regarding the market cycle and the Fitch forecast report, let's analyze it. Number one, supply figures are being overstated. Fitch cited 120,000 units by 2026, but DXB Interact shows only 71,000 units in that period being handed over, with 12,000 units in the next 12 months. Number two, short-term supply impacts pricing. Only 12,000 units will deliver this year, and that's the real number to watch, not distant projections, at least for 2025. Number three, slowdown is not worrying. It's healthy. A gradual consolidation is much better than an overheated bubble. It reinforces market strength on the long term. One of the most important factors driving the strength of the Dubai real estate market in the coming years is the steady inflow of new residents. Just in May 2025, according to DXB Interact, over 223,500 people moved to Dubai. That's 1 month. And among them, between 4,000 and 7,000 are millionaires every year. Now, supply simply isn't keeping up with this pace of demand, and that's why the Dubai government, through its 2040 Urban Master Plan, is planning to nearly double the city's population. To prepare for this, major developers like Miras, Nakheel, and Dubai Properties have joined forces under Dubai Holding to coordinate their efforts and expand intelligently. So when we talk about prices today or over the next few years, we are just seeing early stages. The government isn't increasing supply because demand is low. They're doing it because demand is incredibly strong. Now, why will Dubai still stay strong? Dubai's market remains resilient for several key reasons. Government-led development with massive infrastructure initiatives like the Expo site, new airports, future casinos, not only Ras Al Khaimah, upon developments and landmark projects like Creek Tower, which create ongoing demand. We have prime area resilience, which was also mentioned in the report. Projects in Palm Jumeirah, downtown and other luxury zones tend to resist price corrections. Financial sector stability. Banks have reduced real estate exposure from 20 to 14% of loan portfolios, lowering systemic risk in the UAE. Developer health. Many projects are backed by strong pre-sales and financial backlogs, meaning they can weather moderate price adjustments. Cash-based demand. Around 80% of buyers in Dubai pay with cash, reducing mortgage dependency. Only 20% use loans. This is crucial in preventing over-leveraging. Escrow and regulation. Buyers' funds are protected through escrow accounts, avoiding the misuse of funds that contributed to the 2008 crash. Strategic government planning. With initiatives like the D33 strategy and developer consolidation, Dubai is planning growth, not letting it erupt, ensuring long-term market stability. It's all done gradually. What to expect going forward? Over the next 3 years, we'll likely see continued price growth, slowing gradually each year. No crashes, no stagnation, just mature positive growth. Tourist-heavy zones are stabilizing, while emerging areas will lead the next wave. So we're talking about the average. Overall, the market will be stabilizing. Key takeaway: you can invest at any stage of the cycle and still make money if you do it right. Buy early stage, underdeveloped areas during upswings, invest in premium stabilized areas during consolidation, especially those offering flexible payment plans to ride out slower growth and wait for appreciation. But if we flip this around, it would still make sense. Why? If you're buying developing areas such as Emara Beachfront, pre-COVID or during COVID, you're buying a premium area which will be developed at a much lower price. And similarly, if you're buying prime locations during an upswing, you will make sure to safeguard your capital for a downturn. If you want a private consultation by WhatsApp, Zoom, or in person in our office, do message me on WhatsApp. And for more market updates, new projects, do subscribe, leave a like, and comment what you thought. Thank you very much.